Hey everyone, in this video I'm going to share with you just one ASX BioTech stock that I think that you should watch in 2021 that's pretty worthy of a long-term hold, and I'll let you know the price that I'm willing to buy it at as well. Now there's a general consensus that you should only invest in industries that you understand yourself, and I'm definitely not a medical professional, so if you're anything like me, then probably the Healthcare Index XHJ might be the best option for you. But with CSL pretty much completely dominating that index and itself not really moving much in the past year, there's just one high growth biotech stock and it's the only one on my list. Now, biotech stocks are generally going to be a long-term hold and not something that you should get into if you're just looking for a quick buck. But if you're ready to sit tight and strap in for the ride, we're going to have a good time. Now, if this is your first time here, then welcome. If you're returning, then welcome back to the second video in the stock pick series. But first, let's roll the intro. Now, the only biotech stock that I'm looking at today is the medical technology company Polynovo, which is a spin-off from its parent company CSIRO back in 2004. Their flagship product, Novosorb BTM, is specialized to treat serious burns and to help regenerate human skin tissue using a synthetic material. This is far superior and cheaper than the current treatment, which is to use a layer of donor or even pig skin to temporarily protect the wound while a skin graft is used to replace it. And Novosorb is not susceptible to bacterial infections because it's a synthetic product and not living tissue. Now, you might think, burns? How many people need that treatment? Maybe during bushfire season is a bit of a spike in that product. But here's a fact for you. In the US alone, over 500,000 burn injuries occur that need medical attention. So that's a lot of potential patients that hospitals need to have sufficient orders for. So while it's definitely a specialized product, it's also a huge market that Polynovo could be supplying as well. Now, let's have a look at their financial numbers. Their revenue for the year was up 54% from 2019 at a total of $22 million, with 19 of those million directly from their flagship product Novosorb. Pretty impressive if you only look at the year-on-year growth in revenue. But once you start looking further, we'll start to understand why the company hasn't really taken off yet. With about $26 million in operating expenses, this gives Polynovo a $4 million loss for the year. And yet, the company currently has a market capitalization of around $1.7 billion. This gives a negative earnings per share value, which means their PE ratio is pretty much meaningless. So we will need to extrapolate based on their past performance and their own guidance. The problem though is that even though their revenue has skyrocketed between FY19 and FY20, their operating expenses have space rocketed. Is that a word? So they went from $3 million loss to $4 million loss, with most of that coming from employee-related expenses in 4C. What's going on here? Let's go down to 4C and find out. So here we find that Polynovo has been aggressively chasing new markets and its headcount has almost doubled, and as a result their wages and salary has gone up as well. And another $2 million in share-based payments were made to some employees, as noted in note 6 here. This is actually a good thing because it gives incentives for the company insiders to perform and to have some skin in the game. Well, pun intended. Having some skin in the game is important as well. So far, I haven't even convinced myself that this company is worthy of an investment. It's a loss-making company with increasing expenses and increasing headcount without the revenue to back it up yet, and an overinflated market cap as well. How long is this company going to last? Well, quite a while yet. They have around $11 million in cash, and their cash burn from operations is improving as well. Plus, they have another finance facility of $9 million from NAB, which they'll be investing in new manufacturing facilities and a new clean room for breast and hernia applications as well. So why is this company on my watch list right now when fundamentally there are better companies out there? For me, it's what's in their future pipeline that's really exciting. First, their Novosorb product has been developed into a range of products, including a spray-on application which can compete with another ASX burns company, Avita Medical. Avita Medical is another loss-making, high-growth biotech company that we'll probably talk about next time. Second, Polynovo is entering new markets in the surgical wounds repair for hernia and breast reconstruction, both of which have a market in the multi-billions, especially if they can win contracts in the US market. They are turning their Novosorb into a film extrusion called Syntrel that's also 100% absorbable by the body and is ready to be filed for FDA approval in July 2021. The expectation is that they should be getting a tick of approval on the back of their original product using the same material already being approved, just that this one will be using a different shape for a different application. Once this is done, the company is already gearing up its new clean room manufacturing plan to start selling in the US in 2022. And finally, we can see all of this happening with numerous announcements of more distributors joining the Polynovo network in countries like Italy, Turkey, Poland, Finland, in addition to the existing US and European markets. Now, with the broker consensus that the company is going to be breaking even in FY21 and then reach around $200 million in revenue and net profits of $78 million by 2025, this would give us an earnings per share of around 78 million divided by 661 million shares, which gives us around 11 cents per share. If we buy today at the $2.50 price that's normally sitting at right now, then $2.50 divided by the 11 cents earnings per share would give us a PE ratio of around 22, which is very reasonable for a biotech stock like this. But that's going to be all based on its Syntrel product getting its tick of approval by the FDA and then all its future pipeline coming to fruition in the next 5 years. So, what are the chances of Syntrel getting approved by the US FDA? Well, Syntrel, like Novosorb, is not an organic material and there's no risk of rejection by the patient's body. Plus, having the original product already approved by the FDA, the Taiwanese FDA, Singapore, Indian regulatory bodies, I'm pretty much expecting to hear good news and then a corresponding price jump in the share price. But the main hurdle it faces is its competition, with local ASX competitors like Avita Medical and Aroa Biosurgery, and many other overseas companies as well. I'm going to be keeping an eye on Polynovo to make sure that they are hitting their targets year on year. So for my price target, I'm happy to buy the stock at the 250 to 260 range with a view to hold over the next 5 years. In fact, while I was putting together this video, I put in a sneaky little order for 260 and it's already hit my price target, so I actually already own a small parcel of this. And I plan to pick up more if it dips under this and try to average down my price to 250 as much as I can. I think this company has a really bright future ahead of it and I'm really keen to be a part of it as well. So that's my pick for a high growth biotech stock company in the ASX. What do you think about Polynovo now? Are you going to add it to your watch list as well? Let me know in the comments down below. I make weekly videos on investing like this, so make sure to subscribe if you haven't done that already. And also give me a like if you can, it really helps out my channel. Anyway guys, thanks for watching and as always, I'll see you in the next video.